Welcome back to this edition of Trading Bits and Bytes. Different location. We are at the Nebraska State Fair and lots of things happening here at the fair, and will continue into the weekend. But we're going to talk about some demand issues. We're going to talk about what's been happening in the cattle market as well. We're going to start out with Tori Nielsen joining us from Smart Yield. Let's talk about demand. You know, we talk so much about production all the time, and we've been closely watching this crop grow, but we kind of forget about the other side of that coin, and that's demand.
Yeah, you're right, Susan. We're right here in the middle of the production territory. So we talk about production, especially during the growing season. And this year was a really weird year. So it really captured a lot of our attention onto the production. And the production's been a huge question mark. Even the crop tours, there's still question marks and who believes what tour. And anyway, but the other side of that is the demand side. And we have issues with our soybeans, with trade tariffs, and we also, when you look at the demand on our corn also, our ability to sell our grain out of this country is largely due to the currencies, the U.S. dollar versus foreign currencies. And so when we're not the cheapest in the world, it's hard to export and sell a lot of our grain out of this country. We do have business and we continue, but it's off a little bit. So the number that we really focus on, in our opinion, isn't just the production side, but then on the demand side. And what you end up with is a stocks to use. And that's how big is the pile at the end of the year and what type of demand is on it. And so the stocks to use number is a huge factor in determining the futures market of these commodities. And if you're talking about corn, a 16 plus stocks to use is a huge number, and that's not a bullish number. That's a bearish number. That's not where we're at, but that's a huge one. Anything below 12 is you're going to start firming up these markets a little bit. Right now, the problem is we're around that 14, 15 is the debate, and so 14 and a half on stocks to use is not a real friendly number. And so we're going to have to see some the dollar turnover and pull down to see some demand pick up. And typically what cures low prices is low prices. Right. And so here we are down here in the 370. We're $1 off of the summer high, by the way. And if we can see this dollar pull down, I think we'll see some world demand come into these crops. And so what we hopefully are going to see, in our opinion, would be a demand-driven market after this harvest.
Good thing to think about. Switch gears. Eric Kruger joining us also from Smart Yield. It's been a frustrating couple of weeks for this cattle market. Now we've seen a USDA investigation that's set to take place, but it still has had its effects on the way the cattle have traded, and will, I think, for the time being.
Yeah, I think we're going to continue to see the effects from that fire, and we've seen slaughter actually hold really steady. We've seen slaughter pick up actually week over week, which has been a really big testament to what that market can really do. It makes you kind of scratch your head and wonder, when they say they're running full capacity, are they? But it's nice to continue to push these cattle through. Hopefully it creates and takes some of that margin that the Packers have. The Packers have a huge margin right now. They're making money hand over fist, but it's not translating into the producer side. From cow-calf on up, cow-calf backgrounders and feeders all have the same issue right now, and that is really, really tight margins. And hopefully we can see that the demand of getting through a lot of these cattle and staying current pick that market back up a little bit.
So you're a feedlot owner and you're watching what happens. How do you prepare for profitability knowing the fluctuations that are happening in the trade?
Yeah, that's the toughest part. One of the things you can do is look at right now, if you're going to be that guy that's backgrounding or looking to feed out to next year, take advantage of our seasonal move in the grain markets right now. Lock in some of that cost of gain. Lock in your corn prices, or at least guarantee yourself the current levels and not let them, in case we would see some demand come back in like Troy was talking about, and push this grain market up. We can control that. Getting that margin back comes back to demand and availability, and we need to see consumer demand stay strong. It has been really strong all year. We'll see if that continues. But it's that time of the year where usually we kind of grind into our cash lows and move up from there. So hopefully we can see at least us stay steady into the fourth quarter, especially with August coming off the board. October's got a pretty good discount on the future side to the cash market. So we expect to see cash come down a little bit, but then hopefully the worm will turn.
And I'm really keeping a close eye, as well as what's happening in this grain prices for the demand side for these cattle guys and pork and sheep, everybody that needs to purchase this grain for fall.
Absolutely, and as the hog producer, as the cattle producer, if you're the end user, now is the time to be coming in here and locking up. Maybe it's 30 days or 45 days of feed source, but you need to come in at this point and lock it up, whether you're buying that outright physical or if you're just protecting that upside. Lock in that good feed price for yourself. And like Eric said, seasonal tendencies, we watch seasonal tendencies in all these markets. And the grain markets, surprisingly, are really close to their seasonal tendencies that we've seen for the last 5 to 15 years. And so now through maybe the third week of September is an excellent time to lock up that feed cost.
All right. Thanks so much, Troy. Thank you, Eric, for joining us. That's this week's edition of Trading Bits and Bytes from the Nebraska State Fair. I'm Susan Littlefield.